On Friday, the Bureau of Labor Statistics dropped one of the most alarming jobs reports we've seen in years. The US economy didn't just slow down, it actually went backwards. We lost 92,000 jobs in February. Economists were expecting us to gain 60,000. So that's a complete miss of over 150,000 jobs. And here's the part that nobody's talking about. This isn't just a jobs problem, this is also a housing problem. Because the job market and the housing market are connected in ways that most people don't understand. And what's happening right now could completely reshape what happens to home prices, mortgage rates, and your ability to buy a home for the rest of this year. So today, I'm going to break down exactly what happened in this jobs report, why it matters way more than the headlines suggest, and what it means for the housing market going forward. And stick around because toward the end of this video, I'm also going to explain one scenario that could either crash housing or send prices soaring. And it all depends on what the Federal Reserve does next. So let's dive right into it. All right, so let's start with what actually happened in this jobs report. Because the headline number, minus 92,000 jobs, is bad enough. But when you dig into the details, it actually gets a lot worse. First, the expectations. Economists surveyed by FactSet were predicting the economy would add about 60,000 jobs. Instead, like I said, we lost 92,000. That's not just a miss, but that's a swing of over 150,000 jobs from what was expected. And the unemployment rate ticked up to 4.4% when it was expected to hold at 4.3%. But here's where it gets really ugly. The government also revised the previous 2 months. December's numbers, which were originally reported as a gain of 48,000 jobs, got revised all the way down to a loss of 17,000 jobs. January was revised down by 4,000 from 130,000 to 126,000. Together, that's 69,000 fewer jobs than we thought existed. But now let me put that into perspective. This is the third time in the last 5 months that the US economy has lost jobs. 5 of the last 9 months have shown job losses. And here's a stat that should genuinely concern you. 2025 was the weakest year for job creation since the pandemic of 2020. The entire year of 2025 added just 181,000 jobs total. That averages out to roughly 15,000 jobs a month. Now let's put that into context. In 2024, we added over 1.4 million jobs. And when you look at the last 6 months specifically, we've averaged essentially zero net job creation. The Indeed Hiring Lab put it this way: when an economy stops creating jobs, it's often not long before it starts actively losing them. Now you might be thinking, okay, but what does this have to do with housing? Well, here's the thing. Every single one of those job loss represents someone who is now less likely to qualify for a mortgage, less likely to make a down payment, and less likely to have the confidence to make the biggest purchase of their life. And the ripple effects go way deeper than that even. Let me show you. So let's break down where these jobs actually disappeared from, because it tells us a really important story about the economy. The biggest headline hit came from healthcare, which lost 28,000 jobs. Now, this one comes with an asterisk. A major strike at Kaiser Permanente pulled about 31,000 workers off the job during the survey week. That strike has since ended, but here's why this still matters. Healthcare has been basically the only sector consistently adding jobs for the last year, averaging about 30,000 new jobs per month. One economist from KPMG described the labor market as being held up by a one-legged stool, and in February, that stool got kicked out from under us. Even if you add those Kaiser workers back, the job report is still deeply negative. Now, here are the sectors that matter most for housing. Construction lost 11,000 jobs. That's a huge reversal from January, when construction added 48,000 jobs. Some of this was weather related. There was a severe cold wave in February, but the construction sector has been volatile all year. And fewer construction workers means fewer homes being built, which feeds directly into the housing shortage. Now, manufacturing also lost 12,000 jobs. This is particularly notable because the entire point of the tariff strategy has been to bring manufacturing jobs back to America. And that's clearly not happening yet. The federal government lost another 10,000 jobs. Federal employment is now down 330,000 jobs from its October 2024 peak. That's an 11% reduction in the federal workforce. And many of those federal workers live in high-cost housing markets around Washington, D.C., and other major metro areas. Leisure, hospitality, like restaurants, hotels, entertainment, they lost 27,000 jobs. Transportation and warehousing, they lost 11,000 jobs. And the information sector, which includes tech, lost 11,000 as AI continues to reshape the white-collar workforce. So here's the bigger picture. It's not just one sector dragging things down. Job losses hit nearly every part of the economy in February. And this brings us to the critical question for anyone thinking about buying or selling a home right now, because the relationship between jobs and housing is about to get very complicated. Everyone focuses on mortgage rates when they talk about the housing market. And don't get me wrong, rates matter quite a bit, but there's something that matters even more. And it's the thing that most people overlook: employment. Think about it this way. You can have a 4% mortgage rate, you can have 3% mortgage rates, but if you lost your job or you're worried about losing your job, you're not buying a house, period. And this isn't just theory. A recent survey from Bright MLS found that nearly 2/3 of Americans are worried about possible cuts at their workplace in the next year. Over 60% are worried about losing their own job or having their hours reduced. And more than 80% of renters said they're worried about needing to cut essential spending. When people feel that kind of anxiety, they don't make big financial decisions. They don't sign 30-year mortgages. They don't put down $50,000 on a house. They're gonna wait. And here's the data to prove it. Pending home sales fell 5.8% year over year through mid-February, the largest decline in a year. The typical home now takes 67 days longer to go under contract, a full week longer than 2025, and the slowest pace since 2019. This slowdown is happening despite the fact that mortgage rates just dipped below 6% for the first time since 2022. Let me say that again. Mortgage rates are at a 3-year low, and people are still not buying homes at the rate you'd expect. Why would that be? Well, because rates are only one piece of the puzzle. The other piece is confidence, and confidence comes from having a stable job with reliable income. There's an economist named Lisa Sturdivant from Bright MLS who put it perfectly. She said that even if mortgage rates continue to trend downward, widespread economic concerns will create a significant headwind for the home buying market. Lower rates help, but they can't overcome fear. And this is where things get really interesting, because the job losses we're seeing aren't just keeping buyers on the sidelines. They're about to put the Federal Reserve in an impossible position, and the Fed's next move could determine whether housing prices crash or surge. Let me explain. Alright, this is the part of the video where everything starts to connect, so thanks for hanging in with me through this part. Let's talk about the Federal Reserve, because they are now stuck between a rock and a hard place. And either path they choose has massive implications for housing. See, here's the situation. On one hand, the job market is clearly weakening. We just lost 92,000 jobs. Over the last 6 months, we've had essentially zero net job creation. The labor force participation rate dropped to 62%, the lowest since December 2021 outside of the pandemic. Normally, when the job market weakens like this, the Fed's playbook is simple: cut interest rates to stimulate the economy. But on the other hand, and this is the critical part of this piece, inflation is still running hot. The Fed's preferred inflation gauge, core PCE, came in at 3% in December, which is well above the Fed's 2% target. Inflation has been above the target for nearly 5 years now, and there's a new wildcard making things even worse: oil prices. The conflict between the US, Israel, and Iran has pushed oil prices to their highest level in years. Iran controls the Strait of Hormuz, through which roughly 20% of global oil supply passes. Higher oil prices mean higher gas prices, which mean higher inflation. One Kansas City Fed president said recently that he doesn't think we have room to be complacent on inflation, and that if it becomes ingrained, getting it back to 2% would be difficult and costly. So the Fed is facing what economists call stagflation risk, a scenario where economic growth is slowing and unemployment is rising, but inflation stays high. It's one of the worst economic combinations possible because the tools that fix one problem make the other problem worse. If you cut rates to help jobs, you risk making inflation worse. If you keep rates high to fight inflation, you risk pushing the economy into a recession. Right now, the market is pricing in a 95% probability that the Fed holds rates steady at their March 17-18 meeting. Bank economists expect maybe one rate cut total between now and the first quarter of 2027. That's it, just one cut. The era of rate cuts rescuing the housing market, that may not be coming anytime soon like we thought. Now, the San Francisco Fed President Mary Daly said it best after this jobs report. Both of our goals are at risk now, and we have to keep our eyes on both. So what does this mean for housing prices specifically? Well, it depends on which scenario plays out. And I'm going to walk you through both so you get a good understanding of each, because the difference between them is enormous. All right, so let's go through these. There are really two scenarios that could unfold from here, and they lead to very different outcomes for the housing market. The first scenario, the soft landing. In this scenario, the February jobs report turns out to be a blip. The Kaiser strike inflated the losses, the cold weather hurt construction, and things stabilize in March and April. The Fed holds rates steady, inflation gradually cools, and mortgage rates hover around 6%. In this world, the housing market continues its slow grind. Prices stay roughly flat. Most economists are predicting about 1% national appreciation in 2026. And then more inventory comes onto the market, and some sideline buyers come back. It's not exciting, but it's stable. Here's the challenge with this scenario. Even if it were to play out, affordability is still a massive problem. Mortgage payments have jumped 82% over the past 5 years. And incomes have only risen by 26%. Home prices have risen roughly 50% since 2020, and the median existing home price is still around $405,000. And we're still short roughly 4 million homes nationally due to over a decade of underbuilding. So even in the best case, this market stays tough for buyers, especially first-time buyers and younger generations. Now, scenario 2. The downturn. This is the one that keeps economists up at night. In this scenario, February's jobs report isn't a blip. It's the beginning of a trend. Job losses accelerate. The labor market that's been bending finally breaks. Consumer spending falls. Businesses pull back on hiring even further. And in this world, the housing market faces a real problem. When people lose jobs, they can't make mortgage payments. Delinquencies start rising. Foreclosures tick up, and sellers who were holding out for higher prices get desperate and start cutting. At the same time, fewer buyers can qualify for mortgages, so demand drops. Now, here's the wrinkle in this. If jobs deteriorate badly enough, the Fed would cut rates, possibly aggressively, and that would send mortgage rates down maybe into the low 5% or high 4%. That sounds great for buyers, right? But the reason rates would be falling is because the economy is in serious trouble. Lower rates driven by a weak economy do not create a housing boom. They create uncertainty. And there's one more factor that makes this cycle different from anything we've seen before. Most homeowners today have enormous equity and low locked-in rates. Nearly 80% of mortgage holders have rates below 5%. So even if the economy weakens, most of these homeowners won't be forced to sell. They'll stay put, which means inventory will stay low and prices will stay stubbornly high, and the housing market becomes even more frozen than it already is. This is the paradox of the 2026 housing market. Bad economic news doesn't necessarily mean falling home prices. It may just mean fewer transactions, more stalemate, and even more frustrating market for everyone. So given all of this, the job losses, the inflation problem, the Fed's dilemma, what should you actually do if you're trying to buy a house right now? Let's talk about that. All right, so let's bring this home with some practical takeaways. If you're a potential buyer, The job market weakness is actually creating some opportunities, but only if you're in a strong financial position yourself. Sellers are offering more concessions. One Redfin study found that nearly 2/3 of buyers in 2025 received a discount off the list price. Homes are sitting longer. You have more negotiating power than you had in the past. But, and this is crucial, do not stretch your budget to the breaking point. In an economy where job losses are accelerating, you need a financial cushion. Make sure you could cover your mortgage for at least 6 months if something happens to your income. If you're a homeowner thinking about selling, the spring market traditionally brings more buyers, and mortgage rates near 6% are the best we've seen in 3 years. But the window could be short. If the economy deteriorates further, buyer demand will drop. If you've been on the fence, the next few months might offer the best conditions you'll see for a while. If you're watching the broader economy, pay close attention to the March jobs report coming on April 3rd. If we see another month with a significant job loss, the narrative shifts from temporary setback to trend. That's when things could really get interesting or really scary for the housing market. So the bottom line is this. We're watching two massive forces collide in real time. Mortgage rates are falling, which should help housing, but the job market is weakening, which threatens to undo those gains. The next few months will tell us which force will win. So that's the situation. If you found this video helpful, like, comment, and subscribe, and I'll see you in the next one.